Welcome to topic 2, business structures, part 5. So what we're going to be covering in this video today is we'll be calculating equity at the end of the year for a sole trader. We'll also calculate the amount of profit for the period and the value of the equity at a year end for a private limited company. And then lastly, we'll calculate a change in assets using only the accounting equation. So just a practical video for you to give you some examples and also give you something that you can practice with on your own as well. So starting off with our sole trader example, we've got Hannah. So Hannah's a sole trader operating a small consulting business, and she's asked you to calculate her owner's equity for the year ended 30 June 2010 from the following information. She commenced the business on 1st of July 2009 by contributing capital of $25,000. Profit of $2,400 for the year, ended 30 June 2010, and she also had drawings of $2,000 for the year as well. Her assets and her liabilities look like this at 30 June 2010. So she had some cash, some fixtures and furniture, or fixtures and fittings, got that one, accounts receivable, accounts payable, and a bank loan payable as well. So she's got a little bit of a mix happening in there. So to calculate owner's equity at the end of the year for our sole trader. So our starting point. Her business commenced at the start of the year. So 1st of July 2009. So that's the start of the financial year as well. So equity at the start is 0. So assets minus liabilities at the start, 0. Okay, we've got nothing because she's just starting it up and she hasn't brought any, she didn't really bring any assets with her. Okay, she invested some cash, so we can add on her capital contribution of $25,000. Okay, so that's our starting point. From here, we also know that she made a profit of $2,400 for the year. So we want to add that profit in because remember, profit belongs to the owner. So you've got to add it in. Subtotal, we get $27,400. From this point, what we want to do is we know that there's been some drawings. So drawings is where the owner, I guess you could say, has been paid back some of the money that is owed to them from the business. So we want to subtract off drawings of $2,000. So the business doesn't owe Hannah as much as it did, because the drawings reflect a bit of a reduction in what's owed. So our equity at the end becomes $25,400. So that also is the equivalent to assets minus liabilities at the end of the accounting period. So what we're going to do now is check that equity at the end does in fact equal assets minus liabilities at the end of the financial year. So what we want to do here is add up all of the assets that we were told about. So we take the $30,000. So that was $30,000 in cash. It was $6,000 in fixtures and fittings, and we had $5,000 in accounts receivable. So together, in total, assets come to $41,000. Next, we want to add up liabilities. So liabilities, looking back to our list, our information that we were told. We have liabilities, so we had accounts payable of $7,100, and we have the bank loan payable of $8,500. So altogether, our liabilities come to $15,600. Now we have our totals. We can put those figures into our accounting equation, rearrange such that we will find out what equity is. As we know, as long as we have two inputs, we can find out our third number. So here we have assets of $41,000. We subtract liabilities of $15,600, which gives us owner's equity of $25,400, which is a match. All right, so there are multiple ways to calculate the same item. Sometimes it's going to depend on the information that you have got as to how you can actually go about performing it. Okay, but in this case, we've been able to perform two calculations for owner's equity and we get the same figure each time. So here we've just effectively confirmed our prior calculations. Okay, so the calculations that we've done here, okay, is really quite similar to what you would see on a statement of changes in equity, okay? And we've just confirmed that using the accounting equation. So our next example here, calculating equity for a private company. So we have McLeod Enterprises Proprietary Limited. They started the year with total assets of $60,000, total liabilities of $40,000. During the year, the business earned $100,000 in revenues and they incurred $55,000 in expenses. They paid out dividends of $10,000. So calculate profit and also calculate equity at year end. So our first step is we've got to do profit first, because as we know, profit belongs to the owners. So we can't really calculate owners' equity, which is all about the owners, without knowing our profit figure, because we need to bring that profit figure into our equity calculations. So as we know, because I've said it's one of these super important formulas that you need to know, profit equals revenue less expenses. So in this case, we've got all the information. We know that revenue is 100,000. We know that expenses are 55,000. So profit becomes $45,000. Now we can go on and calculate equity at the end because we have that piece of information. So equity at the start, assets minus liabilities at the start. So we were told our assets were $60,000 and our liabilities were $40,000. So our equity at the start of the period is $20,000. From here, we add in our profit for the period, because again, profit belongs to the owners. So profit for the period, which we just calculated, is $45,000. So just on that note, with the number of your calculations in accounting where they link together, you really need to be very careful when you're performing your calculations, because if you make an error, say at the start of a process, that error will then actually carry through the rest of your process and throw out the remaining numbers. Okay, so that is, it's kind of one of the good things in accounting from the bad things in accounting. You touch one thing, you can kind of affect 100 different things. So it's just, you know, be careful, lots of attention to detail, don't rush, just take your time, think about what you're doing, and again, be careful, because if you've got an error, it can ultimately get very tricky to try and find it, and it can sometimes take hours, which really is not fun. So, going to be careful. Moving on, our subtotal, $65,000, so that's our equity plus our profit. From here, we need to subtract off our dividends. Okay, so dividends, like drawings, it's a way of paying the owners back some of the money that the business owes them. So we subtract off $10,000, which then gives us equity at the end of the period of $55,000. Okay. So a two-step process here, okay, which was needed. Okay, we needed that profit figure to then filter down into our equity calculation. Okay. So you may want to look over this a few times. If you've got it first go, awesome. Okay, then you're on a good start. And our last example, so this one might find it a little more tricky because we haven't really used the accounting equation in this manner just yet. So if we take XYZ Limited, our proprietary limited, if total liabilities decreased by $22,000 and equity increased by $9,000 over a period, by how much did total assets change? Oh, how do we calculate this one? It's not nice and straightforward. It's not like everything else that we've done. We haven't dealt with the accounting equation in terms of changes before. So first time for everything, and here we go. And it really is quite simple. Okay, so we still take our good old accounting equation. It's still assets equals liabilities plus owner's equity. And the numbers that we input here, same as what we've been doing, we're just inputting the change. So our assets equal, I probably should have put change in assets equals change in liabilities, which is that decrease of 22,000 plus our increase in equity of $9,000. Okay, so minus 22 plus positive 9,000, okay, to represent that increase in equity. So really all you're doing is applying these two against each other, kind of like netting them off in a sense. So our change in assets is going to be equal to negative 13,000. So our assets have decreased by 13,000. Okay, so if you take your minus 22,000 and you put a positive 9 into that negative 22, okay, it's going to reduce the amount of that decrease or that negative. Okay, so it's not enough to throw it back into a positive. So that's why that negative is representing that we've had a decrease in assets. So you may find that a little bit confusing, but we're just dealing with change here. We don't really throw too much of this sort of stuff at you, not in this regard anyway. But just break it down. You may need to watch this part of the video a couple more times. Okay, so change in assets, we get that by looking at the change in liabilities, offsetting it with the change in owner's equity. And we derive the negative 13,000 representing a change, decrease in assets. So that now finalises topic number 2. Hope you enjoyed it.